Mortgage Minute brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. Ugly mortgage market right now. It is an ugly mortgage market. The S&P 500 is now down 26 points, giving up all of the gains from earlier today. The 10-year Treasury up 9 basis points, 3.97 where we are right now. Mortgage-backed securities are down 2 basis points. That's after, I'm not sure I remember a day that was worse than yesterday's mortgage bonds action. Down 144 basis points yesterday. What's driving all this? That's the question. Well, we got the Case-Shiller Home Price Index, tracks the changes in value of residential real estate across the U.S., reported for the month of July. National Index covers all 9 U.S. Census divisions, reported a 16.1% annual gain in July, down from 18.7. Well, that's not a problem. I mean, it's still going up. Well, maybe because that means the Fed hasn't got the inflation under control. The FHFA, Federal Housing Finance Agency, House Price Index measures the home price appreciation on single-family homes with conforming loan amounts, decreased by 0.6% in July, which was below expectations of 0.1% gain, and decreased by 2.4% year over year from the previously revised report of 16.3 to 13.9. So that one's still going up. Let's see what else we've got in there. The new home sales measures signed contracts on new homes increased by 28.8% in August to a 685,000 unit annualized pace. July's figure was revised higher to 532,000 from the previously reported 511,000 units. The inventory of new homes on the market increased by 0.4%. Meanwhile, the median new home price decreased by 6.3% to 436,800. So we've got all of that is the stats of the day, the news of the day. The Chicago Fed president, Charlie Evans, was interviewed on CNBC, and he was the first to express that he is nervous about the lag time of Fed rate hikes and feel they could be doing too much before it impacts the economy. He sees the Fed hiking until March and said if inflation starts to really recede by then, they can start cutting rates next year. Unbelievable. So what he's saying is let's keep raising the rates until we see that this indicator that does not appear for 9 to 12 months until it appears. And then we hope that it's still going to be, we're going to still have a control over this. So let's kill the economy until it's really dead, and then we'll try and put it on life support. That's basically what this Fed person is saying. Unbelievable how they do this every time, other than, as I shared with you once in the past, Mr. Volcker came out and had some different issues. OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. Unbelievable. 30-year conforming rates yesterday, they averaged 6.725. That was up almost 0.25% for the day. Jumbos 6.35. That was up about 1/8 for the day. The 30-year FHA loans 6.42, up almost 20 basis points. 30-year USDA 6.314, up 11 basis points. The best loan on the market, the VA loan, got to earn it. 6.311, up 12.1 basis points yesterday. So 12.1 is like 1/8, just to give you an understanding. 21.5 basis points, that's almost like 0.25%. So just to give you an idea for those of you that don't follow all the basis point numbers, that's really where those numbers are. So interest rates going up dramatically because two issues. Number one, the Federal Reserve, that does not affect mortgage rates. You notice the Federal Reserve did not do anything yesterday and mortgage rates went up dramatically. What's really going on is the market is saying to the bond market, we don't have any confidence that the Federal Reserve is understanding the marketplace at all. If we had confidence in them, we would be buying bonds. But we're not buying bonds, we're selling bonds. The reason I know we're selling bonds is because the bonds are going down. When the bond price goes down because nobody wants them, that means the interest rates go up. You've got to get a higher yield. It's just mathematics. It's not an option there. So if the Federal Reserve wanted to try and quelch these things, now they have done this a little bit, is they're not selling mortgage bonds, but if they were to buy a few bonds here and there, that might kind of put a foundation. But they don't want to. They want to see the housing market slow down. Now, we can all see by the numbers I shared with you already that the market is slowing. How do we know that it's slowing? Well, I gave you some areas where we're seeing that the appreciation rates are getting into what I would call more logical area, like the FHFA rate, going from 16.3 to 13.9, still growing too fast, but it's better, right? Because it's not growing as fast. That's why I share that number with you. The new home sales, the median price is coming down a little bit. Not going backwards, but it's coming down a little bit. Case Shiller, 16 from 18.7 to 16.1. So that's dropped off about 10%. All these numbers are positive for a slowing economy. If that's what you're trying to accomplish, that's happening. Now, remember I told you a couple weeks ago that the Fed chair, way back when, Volcker, he came in and he made a comment, and when inflation was at 11%, he started lowering the Fed funds rate. Why did he do that? Because he knew that there was a lag between their actions of today and when they actually went through and hit to the economy. This Federal Reserve doesn't understand that. That's why in November and then in December, they say already that between the two meetings, they're going to increase rates another 0.25% on the Fed funds rate. What does that do? Increases the prime rate, which increases credit card rates that are tied to prime. It increases adjustable rate loans, hurting some of our seniors on their adjustable rate loans if they're in the reverse mortgage world. It hurts business who's got a line of credit tied to prime rate. If you have a personal loan or a home equity line of credit tied to prime rate, it's going to affect you as well negatively. Those are the issues that are going on right now, so we're watching all of that. Again, that is the Mortgage Minute brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products, and I will share with you, our team does have resources for all sorts of weird loans. So we just referred out a family or an investor that had a manufactured property and it was not eligible for government-sponsored entity financing and it needed work to be done on it. Able to refer that out to one of our private money people. A construction loan out of California, able to refer that one out. Apartment loan for 16 units, able to to refer that out. So there's all kind. If you've got a weird scenario, don't go thinking that just because the big bank on the corner said you don't qualify, that you really don't qualify. You might. I'm not saying you will. You might.